Welcome to PhillipCapital's weekly market watch. A lot of attention has been paid to the US economy as of late, and so we have with us today Ms. Hilary Ho, investment analyst from Phillip Securities Research, who will share with us her take on the new economic stimulus plan. So Hilary, could you give us a brief summary of the economic condition of the United States now?
Okay, economic data in the US have not been looking very good, and this doesn't come as a surprise. The trend is that US citizens are cutting down on their consumption and increasing their savings. Personal consumption expenditure have fell by 0.6% in November, and this is actually the fifth consecutive decline. Okay, reduction in consumption is reflected in the advanced retail sales numbers. Advanced retail sales have been in a negative territory for the fifth time. It fell by 1.8% in November from October. Okay, savings on the other hand have actually aged higher, and it has moved higher since August.
What about the manufacturing sector?
Okay, with weaker demand, firms are cutting down on their production. The widely tracked ISM manufacturing index, which stood at 32.4 in December, has failed to increase for the fifth time. This shows that manufacturers are actually pessimistic of the economy and are reducing their production level.
Obama will take office on the 20th of January and has started pre-inaugural talks with the Congress on the second stimulus plan. Could you talk a little on the urgency of implementing the second plan?
With consumption dwindling, there is actually an urgent need to boost spending as it accounts for 2/3 of the country's GDP. So with this bill, it will help to put money into people's pocket, and hopefully that will help to boost consumption and lead the economy to recovery. There is also an urgent need because there is typically a lag in for the effects to be seen and felt. So as Mr. Obama has said, the situation is actually getting worse, and there is a need to break the momentum of this recession.
Could you highlight some major differences between this stimulus bill and the one implemented previously?
Okay, I think there are two stark differences. Firstly, the size of the upcoming stimulus package is bigger relative to the previous one. It is now most often reported to be within the range of $650 to $850 billion. And secondly, this stimulus package will have a greater reliance on tax cuts and an emphasis on low and middle income earners.
To what extent will this latest bill be effective in restoring strength to the US economy?
Okay, it's a faster approach to put money into people's pocket and let them decide how to spend it relative to developing a major spending initiative. So however, with savings trending higher, we don't know how much this plan can boost consumption in the near term. So question remains as to whether the plan is actually affordable. With government deficit already at a substantial amount, the stimulus package will only cause the figure to balloon further. However, having said that, it is nevertheless still very important to implement some physical stimulus package to pull the economy out of the recession.
Thank you, Hilary, for your time. So that's all we have for you today. Tune in next week for more market updates.